Welcome, everyone, and thank you so much for joining us today. My name is Mike Brochel. I'm a managing director with KBRA Analytics and head of KBRA Credit Profile. Alongside my colleagues, Patrick Saprina and Maverick Force, we're extremely excited to partner with the Commercial Observer and share our thoughts on the current state of the office market. We appreciate you taking the time to be with us and look forward to a great discussion. For those of you who may not know us, KCP is a subscription-based research service that was launched back in 2014. We started out by covering 118 transactions that represented the CMBX 1 through 5 indices. And fast forward 10 years, with a team of over 40 commercial real estate credit professionals, we surveil now more than 1,300 transactions. Our coverage spans about 100 series CLOs and over 1,200 CMBS securitizations, including private label conduit, large loan and single borrower deals, and agency Freddie K's. KCP is a division of KBRA Analytics, which also includes KBRA Financial Intelligence, KFI, KBRA Premium, and KBRA Direct Lending Deals, DLD. So what's our process? Well, our team analyzes investor reporting documents, conducts extensive market research, and develops credit opinions on the expected performance of securities in these transactions. Leveraging market data from a consortium of commercial real estate data providers and insights from daily conversations our team has with property managers and brokers nationwide, our goal is to identify loans that we believe exhibit elevated credit risk. We'll then value the underlying mortgage collateral and forecast loan and bond level losses. We offer 6 loss scenarios, including 3 that leverage a probability of default model, and we've partnered with major CMBS data providers to improve workflow efficiencies for investors. Within KCP's online investor portal, subscribers can access transaction-specific credit reports, along with a variety of other topical research covering relevant market trends, at-risk loan sponsors, retailer bankruptcies, and exposure to natural disasters. As part of our series CLO coverage, we provide research and analysis on the publicly traded series CLO issuers. We also provide ESG data in the form of property-level census data from the American Community Survey and property-level environmental metrics, including Energy Star scores, energy usage, water consumption, and greenhouse gas emissions. Issuance has certainly fluctuated considerably over the past few years, influenced by various economic and market factors. In 2020, when the pandemic struck, private label issuance plummeted due to widespread uncertainty, especially in sectors like retail and hospitality. At the time, non-essential retail stores were closed, hotels were shut down, there was travel restrictions and lockdowns in place. So like many other financial markets, CMBS experienced its fair share of turbulence in 2020. Looking at deal count in Q1, there was 31 private label deals that closed, and that dropped dramatically in Q2 with only 11 deals closed and just 1 in April. As the market adjusted, issuance started to recover with 16 private label deals in Q3 and 26 closed in Q4. But overall, by balance, private label issuance fell by 44% from $96.6 billion in 2019 to $54.2 billion in 2020. The market rebounded in 2021 as the economic recovery picked up momentum. There was a lot of liquidity in the system, and with low interest rates, private label issuance rose to $110.6 billion. Conduit issuance remained subdued at just $31.4 billion, below 2019 levels of $49.2 billion, but SASB issuance surged to $79.1 billion, significantly above 2019 levels of $46.5 billion. Multi-loan conduit pools were, simply put, harder to underwrite at that time, and single borrower deals allowed for asset selection, and generally speaking, provided exposure to higher quality collateral. The story shifted again as the Federal Reserve began raising interest rates to combat inflation, which put downward pressure on issuance. Rising borrowing costs curbed deal flow, and private label issuance fell to $70.2 billion in 2022 and only $39.3 billion in 2023. The Fed raised rates 11 times between March 2022 and July 2023. with the target range for its benchmark rate reaching 5.25 to 5.5%. As rates began to stabilize and speculation grew about potential rate cuts in 2024, issuance started to recover. Private label issuance totaled $41 billion in the first half of the year and $68.1 billion by the end of the third quarter, putting the market on pace for approximately $90 billion by year end. The rate cut enacted in September, along with any potential future cuts, should be accretive to issuance going forward. Agency issuance ranged from $61.5 billion to $63.5 billion between 2019 and 2021, so seemingly unaffected by the onset of the pandemic. However, agency issuance did fall in 2022 considerably, down to $46.5 billion and further to $33.3 billion in 2023. By Q3 of this year, agency issuance was at $17.9 billion, on track for about $23.9 billion by year end. Series CLO issuance surged in 2021, reaching a record high $45.4 billion, as borrowers benefited from low-cost floating rate loans and favorable property fundamentals, particularly in the multifamily sector. The market, however, has dramatically slowed since then, with issuance dropping to $6.7 billion in 2023 and $6.8 billion for the first three quarters of 2024. This slowdown is primarily driven by rising interest rates, which have increased borrowing costs and cooled investor demand, particularly for transitional properties. The higher cost of capital has led to fewer property transactions and a decline in originations, as many borrowers now face much steeper debt service. Furthermore, series CLOs have become less attractive as a financing tool for CLO issuers due to higher interest rates and market volatility. As a result, many issuers are turning to more flexible and cost-effective options like warehouse lines for short-term financing, allowing them to manage loan originations and defer securitization until market conditions improve. With additional rate cuts on the horizon, however, we're expecting series CLO issuance to rebound. Okay, looking more specifically at office issuance, the office sector was once a staple in securitization pools, but it's seen its share of issuance decline as work from home trends and rising vacancies reshape investor sentiment. This shift is evident in both private label CMBS and series CLOs over the past few years. In 2020, with mounting concerns over the impact of closures and travel restrictions on retail and lodging, investors leaned into office, which garnered a 37% share for the year. Office exposure fell to 29% in 2021 and 22% in 2022, as uncertainty around office usage grew and work from home trends began to solidify. With rising vacancy rates, an evolving hybrid work environment, and investor aversion for office collateral generally, the allocation fell further to 11% in 2023 and only 10% in the first half of the year for 2024. That's on the private label side. We saw a similar pattern with series CLOs, which saw its share of office decline from 25% in 2020 to 15% in 2021. The decline in 2021 was driven in part by concerns for office, but more so by the surge in transitional multifamily originations, with many investors attracted to growing demand for rental housing at that time. Of the three series CLOs that closed in the first half of 2024, none included office collateral. Of the 6 deals that closed in Q3, there was about $110 million in office exposure. So in total, for the first 3 quarters, for the series CLO market, office exposure was at about 2%. Okay, this graph is from one of our monthly reports titled the KLOC Index. So in addition to transaction reports and special reports, we also have some, non-deal specific monthly reports, and the KLOC Index is one of them. So the report captures the overall KLOC rate for our conduit universe specifically. What is a KLOC, or KBRA loan of concern? Simply put, it's a designation for loans that are in default or at heightened risk of default based on our analysis. In February 2020, so starting on the left-hand side, the index rate was at 7.7%, but by March, it had jumped significantly up to 18%, reflecting the early shock of the pandemic. The rate continued to climb, reaching 26% by June and 29% by the end of 2020. As the economy began to recover and hotels reopened, we did see a decline in the KLOC rate, which fell to 17.5% by the end of 2022. That said, despite improvements in travel, consumer activity, rising rates, inflation, and a growing volume of maturing loans put pressure back on commercial mortgages. Our index rose accordingly to 23% as of June 2024 and 24% as of August. Lodging and non-needs-based retail were hit the hardest in the early days of the pandemic. Loans backed by those property types made up the bulk of new loans of concern that we added in 2020. From the outset, we anticipated that office distress would unfold more slowly, as longer-term leases provided a degree of protection. Initially as well, the market was holding on to the possibility of a full return to office. Demand has not rebounded as expected. Remote and hybrid work models continue to reshape office use, and as companies further adapt, we expect sustained pressure on office demand and valuations. All right, isolating office loans in our universe, conduit universe, we can see that the rate of increase in the office KLOC rate was pretty modest during the first 18 months, from when the pandemic started. As discussed, office properties were shielded initially by longer-term leases, but as leases began to expire and it became clear that the return to office would not reach pre-pandemic levels, the office KLOC rate rose dramatically from kind of middle of 2022 through the middle of 2024. The office KLOC rate is now over 30% and is likely to continue climbing as more office loans mature and struggle to refinance. For context, the national office vacancy rate increased from 11% as of year-end 2019 to over 20% earlier this year. Tenants nationwide are reducing their office footprint and asking for rent concessions, which in tandem has placed downward pressure on property cash flows. Further compounding the issue, operating costs have surged, and many property owners face elevated tenant improvement and leasing commission expenses, adding to financial strain in the sector. As we analyze the evolving office landscape, several key factors we believe are shaping credit quality, both from a risk and opportunity standpoint. On the left, we have the factors currently putting downward pressure on office credit quality. Elevated interest rates, as discussed, higher borrowing costs has made it significantly harder for office borrowers to refinance. Floating rate borrowers have seen a significant increase in debt service in recent years, and fixed rate loans are far more expensive now than in 2019. The cost of replacement interest rate caps has also skyrocketed, pushing many borrowers to forfeit ownership and hand back the keys. Remote and hybrid work, flexible working arrangements have reduced the overall demand for office space, with many companies opting for smaller footprints. This has led to higher vacancies and reduced rental income. Flight to quality, I think, is a big one. Tenants are becoming much more selective and are favoring higher quality, well-located, and amenity-rich properties. This trend has left lower-tier assets struggling to attract tenants, further eroding credit quality. Overall, there's a significant divergence between Class A or, say, A-plus office versus Class B and C. And as discussed, operating expenses are rising. We've seen increases in utility costs, insurance premiums, especially in coastal markets, and real estate taxes, which collectively is putting a strain on property owners. CapEx expense is no different. The cost to prepare and build out new spaces has risen sharply. On the right-hand side, we see factors that, when present, can positively influence office credit quality, particularly for top-tier properties. Modern, newly constructed, or recently renovated buildings tend to attract tenants, especially those seeking flexibility and adaptable spaces. So these properties, your AA plus, are better positioned to compete in the current market. Tenants increasingly value amenities like fitness centers, collaborative spaces, and just proximity to transport and retail hubs. Prime locations, particularly in CBDs, remain attractive despite market challenges. So properties that are, in well-connected areas are generally more resilient in a down market. And last but not least, sustainable buildings and those that are either LEED certified or have obtained other environmental designations are still in high demand. Not only do they reduce operating costs through energy efficiency, but they also attract tenants that have ESG goals. In New York City, operators are working to meet compliance with Local Law 97, which has established a benchmark for greenhouse gas emissions. And we're seeing similar compliance being required in a growing number of markets. So while broad macroeconomic factors are weighing heavily on many office assets, properties that are well located, modern, and environmentally compliant stand a better chance. It's important to remember as well that we evaluate each securitized loan on its own merits, considering regional and local trends and the nuances of each property. And with that, I'll hand it over to Maverick.
Thanks, Mike. Yeah, we'll get into some market specifics here, and I have a few property examples that I want to share as well. We'll start on the West Coast with California. Markets there are dealing with some social and political challenges that aren't maybe as broadly affecting other markets that that we're looking at. They're adding another layer of complexity beyond some of the macro trends like interest rates and remote work patterns that we've seen. On the political side, we've seen some fairly significant challenges and changes on the tax code in LA and San Francisco. In 2020, San Francisco voters actually passed a major increase in the property transfer tax rates there, which actually doubled the transfer rate on transactions over 25 million, moving that rate from 3 to 6%. The additional amounts there that they're collecting under that increase were earmarked for the Housing Stability Fund, which was meant to support social and affordable housing developments. And we'll get into this a little bit more later when we talk about conversions, but San Francisco is actually now looking at reducing the transfer taxes on certain properties to incentivize developments and increase multifamily unit availability. In LA, Measure ULA, which is unofficially known as the mansion tax, that took effect in April 2023 on any transaction over 5 million. Now, that threshold was recently increased in June to slightly over 5 million, but nonetheless, sellers there are on the hook for at least a 4% tax on the sale amount if over that threshold. And similar to San Francisco, or the funds collected there are meant to be used for homeless and affordable housing projects. Generally speaking, rising levels of homelessness and crime have been some of the biggest social challenges faced by these markets and have had a real impact on retailers as well as office users alike. In San Francisco, we've seen a retail exodus with more than 24 retailers, what really most would consider high profile and luxury retailers leaving the downtown and Union Square areas. With a limited number of tenants interested in occupying the ground level, as well as technology tenant exposure in that city that has been, they've been more amenable to the remote work or hybrid work structures. It's really created, a perfect storm of vacancies there. And I found this interesting. The San Francisco Travel Association, they actually are not expecting business convention travel to reach pre-pandemic averages until at least 2030. So that's really telling us that operators of retail, office, hotels, they're all in for, really what seems like, a longer road to recovery. Back down in LA here, real quick, we've seen some similar trends that have played out. We'll talk about Santa Monica here. That market's always been an attractive and competitive market for retailers and office users, particularly those in the technology and entertainment sectors. And by and large, it still is, but the 3rd Street Promenade stood out here. That's an open air, pedestrian friendly commercial corridor. It's just a few blocks from the ocean. It's recently been plagued with a slew of vacancies caused by a number of challenges on the social side, as well as ballooning rents that have really made it uneconomical for tenants to lease space there. But we'll put this into context a little bit. The 14,000 square foot Fremont Moreno 3rd Street Promenade property that's completely vacant. It was once occupied by Victoria's Secret, Mac Studio, which does high-end clothes, and Clark's. When Victoria's left, that space was backfilled by Foot Locker, but now they've since gone dark. So again, we're at a full vacancy there. In 2014, that property was appraised for just under 2,500 a square foot. Our team recently received an updated appraisal that was effective July 2024, and that came in 67% lower at 806 a square foot. Just down the road is the 28,000 square foot office and retail building at 1315 3rd Street Promenade. That was fully vacant after Kitchen United Mix closed their doors there. Now, on a positive note, an entertainment tenant did backfill the 2nd and 3rd floors, although the ground level is still completely vacant and as well as much of the office component on the upper floors. That space is still being marketed. Our team covers that property as part of our ongoing coverage of CRE CLOs. And while we have not received any updated appraisals on that property, our value there does align with the appraisal on Fremont Moreno, as well as other recent sales. The Los Angeles office economy has been somewhat supported by, its diversity in tenant roster relative to San Francisco, which is a lot more tech focused. But the market data there still suggests office vacancies north of 25% within the CBD. Office there is a pretty capital intensive asset class, and we've seen operators really needing to offer very competitive concession and tenant improvement packages in order to attract and retain tenants. Our friends at CompStack actually gave us some great data on the LA market. Tenants signing leases in 2023, they received on average 5% of their lease term rent as free rent, which is 30% increase from free rent provided in 2019. On the tenant improvement side, those packages also jumped more than 30% over the same period. So I have two buildings here that I want to share that really kind of exemplify the lengths that an operator is willing to go to make a deal work. The well-covered, well-storied 1.4 million square foot gas company tower, they were on track there to sign a lease with the city of LA with really quite a large concession package. The city was going to receive a nearly 20% reduction in the face value of their initial lease term rent. And that was through about a $54 million tenant improvement package and rent abatements. That deal did ultimately fall through, but we saw something similar play out at the 1.1 million square foot Wilshire Courtyard office complex, which actually sits between the LA CBD and Santa Monica. But that property was about half occupied before the operator there signed a 225,000 square foot lease with Sony. And that lease was at a 25% reduction to the face value of the lease. And that was through 1 year of free rent and a TI package of about 130 per square foot. So we'll talk about a few of our energy markets here. They've long been experiencing challenges that predate the pandemic, although the pandemic definitely worsened some of the issues there. Denver is one of the most distressed cities that we cover, and that's represented in CMBS. We've identified approximately 65% of all office loans there as loans of concern. And again, that's loans that are either in default or at heightened risk of default. But the CBD has an office vacancy in the mid-30s. And that's really been driven by, exposure to energy tenants, as well as a supply demand issue with better amenitized inventory that has come online in suburban areas. So I have a few value updates that I want to share here. We'll start with one of the more shocking drops here, the 770,000 square foot energy center, which is also known as Denver's World Trade Centers. They're just 32% occupied at this point. Now in 2013, both towers were appraised at 229 a square foot, and a January 2024 appraisal slashed that figure by 80% to just 44 a square foot. Now, slightly less shocking, an appraisal update on the adjacent Columbine Place building, that value was cut by only 79%. A 2015 appraisal of that 150,000 square foot building came in at just 175 a square foot, with a December 2023 appraisal at just 36 a square foot. Now, one more example here, the 1670 Broadway building. It's a 704,000 square foot office tower. They're slated to lose their largest tenant in the next few years here, and KCP's proprietary value aligns with recent appraisals that we received on the Energy Center and Columbine Place. Now, New Orleans is not one of the larger markets that's represented in CMBS, but it did feel worth mentioning. Our team is closely monitoring the 1.2 million square foot Hancock Whitney Center, which is the tallest building, not only within the city, but also across the state. Shell Oil leases space there and uses it as its regional headquarters, and the building has been known as One Shell Square. They're actually relocating only 1 mile into a new built-to-suit mid-rise in the River District. Now, that's a master plan community that's going to have retail, multifamily, and other commercial uses. So it should be a pretty attractive development for tenants moving to the area, as well as for multifamily use. But the move of Shell is somewhat untimely here, just given that the $107 million loan on that property matures in July 2025. Now, we couldn't move on here without talking a little bit about Houston, long home to many oil and gas companies that have actually driven a lot of volatility in that market just due to movements in the price of oil as well as drilling activity. The 425,000 square foot, 3,000 Post Oak property that was fully occupied by Bechtel Oil before the company opted to relocate 8 miles away to a space that's less than half as big on a square foot basis. Our value of 3,000 Post Oak is well below what was once a hypothetical go dark, a value that was provided at securitization in 2019. That hypothetical go dark value was 195 a square foot. And again, at this point, given changes in the market and office more broadly, our value is coming in well below that figure. Now, just up the road is a 436,000 square foot tower at 5599 San Felipe. That building is largely tenanted by Schlumberger. Now, they're an international oil field services company. They lease about 72% of that building with a lease that expires in mid-2027. The real challenge here on that one is an $80 million loan that matures actually next month in November. And we're monitoring that one as we've commonly seen lenders hesitate on properties with large leases expiring in the near term, just given the future risk of cash flow. And on top of that, our team is aware that about a third of the property is currently being marketed for sublease. So all around a negative picture on that one, and something we'll be closely monitoring. On the East Coast here, we'll start with Washington, D.C., which is contending with its own issues in the office space, particularly with vacancy. We're looking at about a 22% vacancy rate there. And that's driven by a number of reasons. For one, the supply-demand imbalance that's been worsened by the pandemic and also supported by really quite a bit of inventory available to tenants in suburban Virginia in markets like Arlington, Fairfax, Reston, and up and around Dulles. It's also a very costly market for operators and tenants. And another shout out here to Comstack. They've given us some more great data on leasing costs over the last couple of years there, which you can see on the slide. In terms of work value, and when we say work value, we're really talking about concession packages that are given to tenants as part of a lease agreement that's in place. So the data shows about an 11% increase across the board between 2019 and year-to-date 2024. Now, for Class A projects specifically, the average package or work value given to tenants is up 14% over the same period. Now, the driver of this growth really is a 40% increase in the work value of tenant-built projects, meaning operators are providing 40% more for things like tenant improvement allowances, built-to-suit projects where a tenant has already been secured and signed a lease. In 2019, the average package offered to tenants at lease signing totaled 78 a square foot, which is well below the 109 a square foot that we're seeing today. Now, on the other hand, operators actually seem to be investing less in spaces without a signed lease in hand. Pre-built or turnkey spec build work values are actually down 28% from 27 a square foot in 2019 to 19 a square foot today. Now, the DC and suburban Virginia markets are obviously quite heavily exposed to the GSA and GSA tenants, which have been reducing space since 2012. Those efforts have been accelerated quite a bit since the pandemic through the Workplace 2030 initiative. Now, that plan is relatively vague, but it does outline, 4 primary objectives, and I'll, read them off real quick here. So, one, they want to reimagine the workplace, support real property strategies, provide smarter spaces, and enable workforce mobility. That plan was rolled out leading up to the pandemic. But I think the bottom line here is that we should really expect the GSA to keep reducing their footprint. And they've really outright stated as such. Their estimated utilization is only 30% below pre-pandemic, and about half of its outstanding leases are up for expiration in the next 5 years, which could really support some downsizing initiatives there, some consolidation in that space. But the lease expiration itself might actually matter a little bit less here, because GSA leases, they're often structured with early termination rights, whether that's for the entire space or for only a portion. But those structures definitely introduce a bit more cash flow risks, a bit more uncertainty, and definitely could help support some of these broader initiatives within the government to reduce their lease inventory. So we'll wrap up our market review here with a discussion on New York City. Office vacancy there is north of 20%. However, the market actually has seen some positive trends in terms of office visitation that's improved considerably. And that's by and large owing to its more diverse economy and exposure to finance and law tenants that really are more amenable to in-office work. Now, utilization there still does trail the pandemic, but the Real Estate Board in New York puts together some pretty consistent data on Manhattan office visitation. And in July 2024, their data showed that visitation reached 78% of 2019 levels, and that data excludes the holiday week. Their data also shows a flight to quality, that trend that we've been seeing play out across the board. Their data is showing that in real time. So for Class A plus properties specifically, they actually saw visitation at 86% of 2019 levels in July. So definitely some bright spots there, and some properties that are performing better at the expense of others. The Class A plus A dichotomy against Class B and C inventory that may not be as well amenitized or as well located. Now, a few things I do want to note here that could also impact office in one way or another. The city of New York is currently evaluating its office footprint, and that's due to budgetary shortfalls that they're looking to solve. So the Department of Citywide Administrative Services has been instructed to identify really any redundant or underutilized square footage that's leased to the city. And it'll be interesting to see what comes of that, given that the city leases about 22 million square feet at a cost of more than 1.1 billion a year. The administration is also committed to adding about 500,000 new multifamily units to the city by 2032. So that goal could actually help support some recent property conversion initiatives for underutilized office buildings. And we can jump to the next slide here as we talk a little bit more about conversions. So while conversions have been, a hot topic in commercial real estate lately, feasibility seems a lot less. It seems a lot less feasible to for some of these projects to pan out. So recent studies have shown that only about 1% to 3% of office in the city of New York is actually convertible, whether that be from a zoning perspective, from a floor plan perspective, or just making the project economical from an investment perspective. But nonetheless, the properties that are converted could definitely help ease some of the pressure on vacancy in New York and elsewhere, and be a viable pathway for some of the distressed inventory that really would be otherwise functionally obsolete. So a few things that we're looking at when we're looking at whether or not conversion could be in play. It is the age of the building. The older the building, the smaller the floor plate generally is, which makes it a little bit easier to convert into multifamily units and meet some of the ventilation and natural light requirements for residential use. We're also looking at zoning. I mean, that's going to be a deal breaker. If the zoning doesn't allow for multifamily use or isn't flexible to provide multifamily use, obviously that project's not going to be able to move forward. Developers are going to need to acquire these properties at price points that are really going to make sense, as multifamily. And the price point is going to have to be at a place to not only offset the cost of acquisition, but also the risk and cost of the conversion itself. And so what we're really seeing happen now is these projects, they need tax and other financial incentives to pencil out. And those things have become a real core part of the equation. So a few great examples here. So going back to San Francisco for a moment, they passed Proposition C earlier this year. That was on the ballot. And that policy will actually waive transfer taxes on commercial to multifamily conversion projects when the property is sold for the first time after the conversion. The city is limiting that waiver for up to 5 million square feet of converted space in aggregate, but that should provide plenty of runway for developers to take advantage of that program across the board over the next several years. In Chicago, they've been rolling out their LaSalle Street Reimagine initiative. Now, that initiative has actually earmarked $150 million in direct funding to support 4 office to multifamily conversion projects. And those projects are in the Chicago Loop. Now, 4 have already been selected and approved by the Community Development Commission. And those 4 projects should bring more than 1,000 new units to the Loop. And now, earlier this month, the building at 79 West Monroe Street was the first of 4 to actually receive city council approval, and they awarded that project $28 million directly. So the developers there are looking to redevelop 8 floors into 117 units, of which 41 will be marked as affordable. The developers themselves are also contributing 28 million of their own funds. Now they're also receiving about 8 million in historic tax credit financing as well. So a lot of sources there to make that deal work. But all parties feel it should be successful, and it'll be interesting to see how Chicago evolves some of its vacant office space into multifamily. Now, in addition to some of the financial incentives, New York has really gotten a lot of attention recently for its office conversion accelerator program. Now that really is a interdepartmental, interagency board that was set up to kind of help developers on the due diligence side and help them, work through the approval process and kind of cut through some of the red tape and some of the bureaucratic processes that often slow these projects down. They've actually seen interest in conversions double since they launched that program. So whether those projects pan out or not remains to be seen, but it's definitely helped a lot of developers get the conversation started. Within CMBS specifically, conversions and really major renovations are really not permitted just due to some of the restrictions there as part of the securitization. But our team is regularly reviewing distress inventory, and we're kind of pricing out what a conversion could look like through our multiple evaluation scenarios if we feel that that's a potential pathway for a future developer, future operator. Now, with that said, we are actively monitoring the 7600 Leesburg Pike property. That's just outside of DC. It's a 219,000 square foot suburban office that was securitized in a CRE CLO. At the time of securitization, the sponsor had planned to complete about 2 million in capital improvement on the property, and that included common area upgrades as well as a few build out spec suites. The plan was completed, but occupancy never reached its projections, which was around in the mid 80s. At best, the property only leased up to 66%, with the latest reporting actually showing occupancy at only 35%. So at this point, Citus is now actively managing that property. And when they took over management, they conducted a highest and best use analysis. That study must have shown the property would be better suited as a multifamily, as shortly thereafter, they submitted some rezoning applications to the county board and have submitted some plans to redevelop that property from office into 165 townhomes. So definitely one we'll be keeping an eye on as that story unfolds as well. With that, I'll pass it over to Pat, who will get into what we're seeing as loans hit maturity.
Thanks, Maverick. Shifting gears here again, just for the last segment of our discussion, I wanted to touch on kind of what we've seen so far with office maturities, what we can expect going forward, and how this is influencing credit quality and also underwriting standards. So 2022 and 2023 were obviously challenging years for the financing markets due to rising interest rates and persistent inflation. Late last year, when the Fed paused rate hikes, that allowed for some market stability that helped boost liquidity with marginally improved borrowing costs over time. And expectations for the Fed's eventual rate cut in September have largely been priced into the market of recent. And although capital remains expensive relative to where we were several years ago, there's a clearer picture kind of where the Fed's rate path is going, and that's allowed overall CMBS issuance to bounce back from lows in 2023. On the whole, we've definitely seen traditional bank lenders pull back a bit from CRE lending in recent periods, but the roster of financing sources available to would-be borrowers has remained diversified. And we've seen private capital step in to kind of fill the void in many cases to get some of these deals done. For existing loans on office, where we're seeing cash flows that are stagnating or falling, and where we've seen value depreciation and borrowers that maybe aren't as well capitalized, that's definitely contributing to growing levels of distress and increasing defaults in CMBS. As Mike explained earlier, our team performs valuations on the properties collateralizing CMBS loans in our coverage universe, and these are updated on a regular basis, which we use to derive KBRA loan to value, or KLTV. What we wanted to look at was, KLTV migration over time to kind of get a sense of the direction of CRE values and maturity default risk. So just looking at all conduit loans in our coverage universe maturing during the second half of 2024 through 2026, the weighted average KLTV was 79.1% as of June 2024, which was notably higher than 65% that we saw in June 2019 prior to the onset of the pandemic. Isolating just office loans, you can see the two bars on the right in the weighted average KLTV migration chart. Our data indicates weighted average KLTVs closer to 91% today versus 64% 5 years ago. And there are certainly office loans in our coverage universe with higher LTVs where we're forecasting principal loss, but just that shift, is pretty notable. And that depreciation implied in property value is certainly going to increase default risk going forward, particularly for office loans. And just to note, it's not visible here, but we observed a similar trend, deterioration in performance metrics for debt yield and DSCR for office, which both declined over that same 5-year period that we looked at. Understanding kind of where property values are trending, we weren't too surprised to see repayment rates decline over the past several years. So just over a third of office loans that matured during the first half of 2024 were successfully repaid or refinanced. That's down from 53% in 2023, and then a 90% payoff rate in 2022. And just to note that these repayment rates aren't exclusive to CMBS, but representative of the broader CRE financing market. So again, even as the rate path improves, the secular shift that we're seeing in office demand and as well as recent leasing trends, which, as Maverick mentioned, feature elevated concessions and in many cases lower rents in certain markets. These are all going to continue to impair property cash flows and values, which we expect to exacerbate the maturity default risk and loss potential, despite recent improvements in the cost of capital. So here, what we wanted to kind of demonstrate was just a simplified refinancing scenario using the $400 million Bank of America Plaza loan. This is securitized across 4 CMBS conduit transactions. And this is meant to underscore just the challenges many borrowers are facing as some of these loans come due. So it's an interest-only loan. There was no deleveraging through amortization during the loan term. And it's backed by a 1.4 million square foot office property in downtown Los Angeles, which, as Maverick mentioned earlier, is definitely a market experiencing a lot of the same challenges that we're seeing broadly as far as it relates to demand disruption and higher vacancy rates. The property is part of the Brookfield DTLA, or Downtown LA Fund, which included Gas Company Tower and EY Plaza. Those were 2 notable defaults spurred by the fund's inability to cover rising debt service costs as interest rates increased. Bank of America Plaza, however, is a fixed rate loan. And while occupancy has declined over time, it was reported at 79% in June 2024. And that was down from 86% late last year. Cash flows held up owing to some of the longer term leases in place. Nevertheless, the loan was transferred to the special servicer in July of this year prior to defaulting at maturity in September. And when you look at the loan's current interest rate at just about 4% relative to kind of prevailing market rates right now, the problem becomes pretty clear as to why refinancing is such a challenge. So the data in the table furthest to the right in this slide displays the percentage of full-term interest-only loans, weighted average interest rate, DSCR, debt yield, and appraisal LTV for office loans securitized in CMBS during the first half of this year. And then to the left, what we've done is outlined kind of several or multiple hypothetical debt service coverage ratios, assuming a refinance at different interest rates, including that 7.29% weighted average for CMBS in 2024. And what we did was start with the 4.05% interest rate on the existing loan and kind of scale it up from there in 1% increments. And you can see that at every level, the hypothetical DSCR is falling well short of that 1.94 weighted average that we're seeing as far as office loans contribute to conduit CMBS during the first half of 2024. And then not only that, when we back into kind of a hypothetical principal balance, assuming this new loan is underwritten using the $34.1 million cash flow figure most recently reported by the property to achieve that weighted average 1.94 DSCR at the weighted average 7.29% interest rate, $241.8 million principal balance that current cash flow could support at those underwriting levels is just well below the $400 million outstanding loan balance. So pretty wide gap there for the borrower. And then if you take it a step further, applying that 52% weighted average office appraisal LTV for 2024 to that hypothetical $241.8 million refinance principal balance implies a $463.2 million property value, which to us just seems unrealistic It's significantly higher than what our current concluded value of the property is right now, which is forecasting a large loss on the existing $400 million CMBS loan. So all this is just to say that for many borrowers, just the gap between what's needed to pay off the existing debt and what current market conditions will allow can be insurmountable for some. In the case of Bank of America Plaza, the special servicer and the borrower are apparently still in discussion regarding a potential maturity extension, and we'll see where things go from there. Using the property's neighbor gas company tower as an example, that property eventually entered receivership after default, and it looks like it could be sold to LA County for around $200 million, which is well below the $632 million appraisal value on that property from 3 years ago, and also well below that particular loan's outstanding principal balance. So on the whole, and this includes all commercial real estate mortgages nationwide, we're looking at $2 trillion of that $4.7 trillion outstanding balance maturing over the next couple of years, according to Mortgage Bankers Association. And according to MBA's year-end 2023 survey, loans totaling over $900 billion were expected to mature in 2024. Office was about $206 billion of that, which was second just to multifamily at $257 billion. So that $930 billion, call it, maturity balance was a large increase from MBA's prior year-end survey, which gauged about $660 billion maturing during 2024. And that's due to roughly $270 billion or so in 2023 maturities that didn't pay off on time and were pushed into 2024. And that $930 billion now expected to mature by the end of this year itself represents a 28% increase from what was slated to mature back in 2023. So what we're seeing is kind of this like pile-on effect as more and more loans default and are either formally modified and extended or remain in some kind of workout state with lenders and special servicers. So the question is, how are CMBS trusts going to deal with this? We've been predicting and are now seeing more modifications. These are increasing at a steady rate, most of which are inked to facilitate a loan extension, many of which feature some kind of principal pay down or equity commitment from the borrower. For assets where borrowers aren't willing to or able to commit capital to stabilize the property or kind of weather things out until economic conditions improve, we're definitely expecting an increase in deed in lieu or foreclosure situations, and maybe in some edge cases, discounted payoffs where borrowers were able to sell the property or refinance, but proceeds fell short of that outstanding loan balance. However, special servicers and trusts deemed that recovery represented kind of the maximum principal recovery to bondholders and elected to permit that discounted payoff or DPO. Just a recent modification example is the $975 million One Market Plaza loan. This wasn't paid off at maturity in February 2024 and was eventually modified to include a 2-year extension to February 2026, along with 2 additional 1-year options. So the property is a $1.6 million square foot Class A office complex in San Francisco's South Financial District. And it's been well occupied around the mid-90s since the loan was originated back in 2017 and has actually seen some cash flow growth. But even so, to secure this extension, the borrower agreed to pay down the loan by $125 million. So going from $975 million to $850 million, or roughly 13% of that original loan balance to get the deal done. On the horizon for the property, we know that Google, which leases 22% of the building, is unlikely to renew its lease when it expires next April. Despite that, the borrower is still demonstrating some commitment here, and we'll definitely be monitoring this one to gauge whether the modification with the extension options, along with the principal reduction, are enough to facilitate an eventual full principal recovery in the future. And that's something that's also going to depend on leasing conditions improving in San Francisco, where, as described earlier, we've definitely seen outsized dislocation relative to some other major office markets. And just to note, there was an updated appraisal performed around the time this loan defaulted in February, which resulted in a value of $1.26 billion or $794 per square foot. And that was roughly 30% below the $1.77 billion value or appraised value of the property from 2016. So, what's ahead for CRE maturities? As mentioned earlier, according to MBA's year in 2023 survey, roughly 600 billion in CRE loans in total, not just the MBS, were expected to mature in 2025, followed by 450 billion in 2026 and 330 billion in 2027. These numbers are certainly going to increase given the repayment rates that we've seen so far and kind of what we've seen deferred from 2023 into 2024 and what we expect to be pushed into 2025 out of the loans that weren't able to pay off at maturity in 2024. We're certainly expecting this accumulation effect to continue over the next several years. As far as recent issuance goes, and how that's been impacted by general office conditions, we looked at weighted average interest rates, at issuance, DSCRs, debt yields, and appraisal LTVs for office loans securitized back in 2019, and compared to the same metrics observed during the first half of 2024. And this is exclusive to the CMBS conduit deals. So the obvious change is the rise in interest rates going from just over 4% to 7.29% on average. DSCRs here are understandably lower given the higher cost of capital. And then if you'll recall from a few slides ago, 86% of these loans securitized during the first half of 2024 are full-term interest only. Debt yields, on the other hand, have improved a bit, going from 10.3% to a little over 14%. And I think this also coincides with the lower weighted average LTVs we're seeing, so 52% today compared to 57% in 2019. As lenders attempt to manage just the inherent risks associated with the office sector. One other way the industry's reacted in recent years to higher interest rates has been shorter term loans. And that's owing to the fact that both borrowers and lenders were reluctant to lock in long-term fixed rates amid all the uncertainty around the Fed's approach to kind of managing inflation and economic conditions. Whereas we're used to seeing primarily 10-year fixed rate mortgages represent the vast majority of CMBS conduit deal collateral. Within the last couple of years, we've observed kind of the emergence of the 5-year deal, which in 2023 by deal count represented 42% of conduit issuance. And that actually increased during the first half of 2024 to 69% of conduit deals under this 5-year program. With the Fed signaling additional rate cuts and the path forward on rates becoming kind of somewhat less hazy now than where we were earlier this year or even last year, it kind of remains to be seen whether 5-year conduits will remain a long-term fixture in future CMBS issuance. And with that, we'd like to conclude today's webinar and covering KBRA Credit Profile's take on the state of the office market. Just wanted to say thanks to Mike and Maverick, and of course, Commercial Observer for facilitating today's conversation. Thanks to everyone who was able to tune in. We certainly appreciate it. Please do reach out with any comments or questions. We're always happy to connect, and have a great rest of your day.